Last January, you said you'd start investing this year. It's been 12 months. You still haven't opened an account, not because you're lazy, not because you're bad with money. You just felt like you didn't know enough yet. Like you needed to learn more first. Pick the right thing. Wait for the right time. But here's what nobody told you. Every single month you waited cost you more than you think. And by the end of this video, you'll see the exact dollar amount your hesitation has already lost you. That number, it's going to hit different. You already know investing matters. That's not the problem. The problem is every time you think about starting, something stops you. Maybe you looked at your paycheck and thought there wasn't enough left over. Maybe you opened an investment app and felt overwhelmed by the options. Maybe someone told you that you need at least $1,000 to even get started. Or maybe, and this is the most common one, you told yourself you'd start once things settled down. Once you got that raise, once you paid off that card, once you understood the market better. According to a 2023 Gallup survey, only 59% of Americans own any stock at all, and for women, that number drops even lower. The gap isn't about intelligence, it's about access to information. You were never sat down and shown the basic math. Nobody walked you through what happens when money just sits in a savings account earning 0.5% interest. Nobody showed you what happens when that same money goes somewhere it can actually grow. That's what this video is for. Forget everything you think you need to know. The only thing that matters is one number, and that number is time. Before we get to the numbers, you need to understand one concept. It's called compound interest, and once you see it, you can never unsee it. Here's how it works in plain English. When you invest money, it earns a return, maybe 8% a year on average. That's close to what the stock market has returned historically, according to the S&P 500's long-term average. So if you put in $1,000 and it grows 8%, at the end of year one, you have $1,080. Nothing crazy. But here's where it gets interesting. In year two, you don't just earn 8% on your original $1,000. You earn 8% on $1,080. That means your money earns $86.40 instead of $80. Year three, you earn 8% on $1,166. Then 8% on $1,260. Each year, the growth gets bigger. Not because you added more money, but because your earnings are earning their own earnings. Think of it like a snowball rolling downhill. At the top of the hill, it's tiny, barely noticeable, but the longer it rolls, the faster and bigger it gets. The snowball doesn't need you to push it harder. It just needs time on the hill. That's why starting matters more than starting perfectly. Every year your money sits on the hill is a year the snowball grows. Every year you wait to put it there is a year you can never get back. The growth you missed doesn't just disappear, it compounds. That missed growth would have created more growth, which would have created more growth. The early years aren't about the money you invest, they're about the time you give it. Now let's run the real numbers. This is the part that changes everything. Imagine two people, same job, same city, same paycheck. Both can afford to invest $200 a month. Person A starts at age 25. Person B waits until age 35. Both invest until age 60. Both earn an average return of 8% per year. That's 35 years for person A, 25 years for person B. Let's break it down. Person A invests $200 a month for 35 years. That's $2,400 a year. Over 35 years, she puts in $84,000 of her own money. That's her total contribution. But with compound interest at 8%, her account grows to roughly $383,000. Person B invests the same $200 a month. Same 8% return. But she only has 25 years. She contributes $60,000 of her own money. Her account grows to around $150,000. Let's pause on that. Person A has $383,000. Person B has $150,000. The difference is $233,000. But how much more did person A actually put in out of pocket? Only $24,000 more? Just $24,000 in extra contributions. The other $209,000, that's compound growth that person B can never recover. Not because person B didn't try hard enough, not because she invested wrong, she just started 10 years later. That's it. 10 years of waiting cost her over $230,000. And here's what makes this even harder to hear. If person B wanted to catch up to person A by age 60, she would need to invest roughly $500 a month instead of $200. More than double. That's the real price of waiting. It's not just the money you didn't invest. It's the growth on the growth on the growth that you will never see. This is the math they should teach in every school. They don't. So if the math is this clear, why isn't everyone investing? Because the system doesn't make money when you invest early in simple funds. Think about who profits from your confusion. Banks want your money in savings accounts earning 0.5% because they take that money and lend it out at 7%, 8%, even 24% on credit cards. Your $5,000 sitting in savings earns you $25 a year. That same $5,000 earns the bank 10 to 20 times more. Financial media profits from making investing feel complicated. The more confused you are, the more you watch. The more you watch, the more ads they sell. They don't want you to open one simple account and walk away. They want you glued to tickers and panic headlines. According to Dalbar research, the average investor earns about 3.6% per year. The market averages around 10%. Why the gap? Because people panic. They buy when things go up. They sell when things drop. They react to the noise instead of doing nothing. And doing nothing, meaning staying invested, is historically the most powerful strategy. The financial services industry earns over $600 billion a year in the U.S. alone. That money comes from complexity, from fees, from products you don't need. The less you know, the more they earn. Your hesitation isn't an accident. It's profitable for someone else. The system was designed so that confusion feels safer than action, but the safest thing you can do with your money is give it time to grow. The objection you hear most, and probably the one in your head right now, is this: I don't have enough money to start investing. It feels real. After rent, groceries, bills, maybe debt payments, there's barely anything left. But here's the truth backed by math. $50 a month invested at 8% for 30 years grows to over $68,000. You probably spend more than $50 a month on subscriptions you forgot about. A 2022 study from a major financial firm found that the average American has $219 per month in subscription services. You don't need to cancel all of them, but if you redirected even $50 of that, you'd have a retirement account growing while you sleep. The other version of this objection sounds like this: I need to learn more before I start. But learning without doing is just another form of waiting, and we already know what waiting costs. So here's your action plan. Step 1. This week, open a free investment account. Most major platforms let you start with $0. It takes about 10 minutes. Step 2. Set up an automatic transfer of $50 a month. Automatic is the key word. You want this to happen without you thinking about it. Step 3, put that money into a broad index fund. That's a fund that tracks the whole market. You don't pick individual companies. You own a little piece of all of them. The average return of the S&P 500 over the last 30 years has been roughly 10% before inflation. Step 4, do not touch it. Don't check it daily. Don't panic when it drops. The market has dropped and recovered every single time in history. That's it. 4 steps, 10 minutes to start, $50 a month, no perfect knowledge required. 2 people, same age, both are 28, both make $45,000 a year. Same city, same rent, same bills. Person A hears this video and thinks, I'll get to it eventually. She puts it off for 10 years. At 38, she finally starts investing $200 a month. She invests for 22 years until age 60. At 8% average return, she ends up with about $117,000. She contributed $52,800 of her own money. Not bad, but not what it could have been. Person B watches this same video tonight. Tomorrow morning, she opens a free account. She sets up $200 a month on autopilot. She doesn't think about it again. She invests for 32 years until age 60. At the same 8% return, she ends up with roughly $340,000. She contributed $76,800 of her own money. The difference in their contributions? $24,000. The difference in their outcomes? Over $223,000. Person A is not less smart. She's not less disciplined. She just waited. And that wait cost her more than $200,000 in wealth she will never build. Person B didn't invest more wisely. She didn't pick better funds. She didn't get lucky. She just started sooner. That's the only difference. Time. The most valuable asset you own is the one you're spending right now, deciding whether or not to start. You already have what you need. You are not someone who doesn't invest anymore. You're someone who knows the math now. You've seen what time does. You've seen what waiting costs. And you know that $50 a month is enough to change your future. This is not your fault. Nobody taught you this. But starting today, you know. And knowing changes everything. Subscribe to She Starts Today. She was never taught this, so she's learning it now.